Food prices, especially that of tomatoes, painted the inflation red in July. It touched a 15-month high figure of 7.44%. While most experts agree that the August figure will offer some relief, they agree that it will still be higher than 6%. As the inflation figures were made public, all attention turned towards the central bank, the RBI. Its Governor Shaktikanta Das reassured people on September 6 that RBI is firmly focused on bringing down inflation to 4%. But a development on foreign shores may make Governor Das's task a bit more challenging. It may also pose a challenge to the government's fiscal maths. In coordinated statements, Russia and Saudi Arabia announced to extend their cuts in oil supplies through the rest of 2023. It gave a push to already rising crude prices, which settled above $90 a barrel for the first time this year. Crude prices have risen more than 20% since mid-June. The recent move has ignited fears of a global oil supply shortage, as these reductions come on top of the oil export cut agreed by several OPEC Plus producers in April this year, till the end of 2024. India primarily imports from OPEC countries. The crude oil free on board or FOB price for the Indian basket has been on a steady rise for the last 2 months. The average crude price for India increased from $80.37 per barrel in July 2023 to $86.43 per barrel in August 2023. The latest prices for September 2023 have been pegged at $89.81 per barrel by the Petroleum Planning and Analysis Cell of the Government of India. So is oil going to be the next big worry for India?
The economy is growing at over 7%, which needs a lot of oil and gas to meet the growing needs of the economy. And on the other hand, domestic production is falling. So you're left with a situation where you have to import. At the moment, we import around 4.5 million barrels a day. So roughly about 130 million barrels a month. That would be about 1.5 billion barrels a year. If oil prices go up by even $1, so that means that every month you end up paying $130 million more. And over a year, it comes to over $1.5 billion. This is just for a $1 difference in oil prices. And that exactly is India's biggest worry.
But some experts differ.
Short-term strategic kind of a move by Saudis and Russians to cut the production, but I don't think they can sustain that cut in production for a long time, because it will have a double whammy impact on the demand for oil, because the economies are slowing down.
India imports more than 85% of its oil requirements, which make it vulnerable to global oil price fluctuations. The net import bill for oil and gas was $9.8 billion in July 2023. It was $15.8 billion in July 2022. One of the reasons for this drop in import bill could be due to discounted crude imports from Russia. Crude oil imports from Russia rose nearly threefold in the first quarter of this fiscal when compared to the same period of FY23. But crude oil imports from Russia fell by 23.4% month-on-month in August. Maintenance outages at some plants and lower discounts for Russian grades were cited as reasons. So if the crude prices continue to remain inflated for a longer period, India may see a heavier import bill. Experts believe that it may widen the current account deficit, or CAD. According to credit rating agency ICRA, for every $10 per barrel increase in price of crude oil, the CAD could widen by 0.14% of GDP. High oil prices also push the US dollar above against its peers. It leads to weakening of the Indian rupee. Last week, the rupee closed at a fresh low of 83.21 against the US dollar, and the head of global foreign exchanges at Jefferies told Reuters that the rupee may shift to 83 to 85 per US dollar if oil prices remain high. Further, fuel and light contributes 6.84% to India's CPI basket. A rise in crude oil prices can push inflation. The International Energy Agency has said that a 10% increase in crude oil prices in India will lead to a 0.9% increase in the country's wholesale price index. So, how will the rising oil prices affect RBI's inflation fight?
RBI higher oil prices do not directly feed into India's economy right now in terms of fuel cost. That is because petrol and diesel prices have been controlled for over a year. LPG price has been arbitrarily reduced by 200 rupees.
We have some kind of a policy cushion when it comes to oil prices, because if you've seen in the last 1 year, India has not adjusted the domestic price and at the same time, India also has imposed some kind of import tariffs. So if it really worsens further, government can reduce the tariff rates, or oil companies can adjust their profits. So to that extent, you may not transmit the hike in international oil prices to domestic consumers.
The Reserve Bank of India's MPC in its last meeting kept the repo rate unchanged at 6.5%. But it's so far been keeping a hawkish outlook on interest rates. A high inflation caused by a rise in oil prices might force it to increase interest rates. Experts believe that this could lead to high prices and consequent reduction in demand, especially during the upcoming festive season. The election season is also here, and the government may not pass the burden of hike in crude oil to consumers and absorb it instead. It will further increase its subsidy burden. LPG rates have already been slashed by 200 rupees a cylinder. These steps are likely to widen the fiscal deficit. The fiscal deficit for the first 4 months of FY24 has reached 6.05 trillion rupees, which is 33.9% of the FY24 budgetary estimates. So will this jump in crude prices and upcoming elections affect the government's fiscal maths?
Oil companies are making windfall profits, and if the oil price continues to be at 90 plus, the oil companies have to adjust their own profits, and that will also have some impact on the revenues for the government. But having said that, I think the government has made better profits in the last few quarters on the oil companies. Net, in my view, I think the impact of oil price going to 90 on fiscal again would be minimal.
Clearly, a short-term jump in crude prices may have little impact on government finances. But if the prices remain above $90 a barrel for a long time, like a year, it may affect the government exchequer.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.